Every single year, hundreds of millions of metric tons of raw chemical feedstocks move continuously across the world's oceans. Profitability in this heavy industry is driven by daily, hyperlocal fluctuations in upstream raw material pricing. The primary intelligence artifact tracking these shifts today is the August 10, 2026 Feedstock report from Polymer Bazaar. We are applying their analytical framework of price, prediction, and profit to today's numbers. We map three primary hubs: the U.S. Gulf Coast, Northwest Europe, and Northeast Asia. Monitoring daily price aggregates across these zones pinpoints pressure points in the global supply chain. We deconstruct FOB, CFR, and CIF pricing to locate opening and closing arbitrage windows. Interpreting these regional price disparities dictates whether a trader simply moves volume or captures actual margin. We start upstream in the Asian market, where the physical infrastructure for cracking raw crude begins. Today's foundational data point is naphtha, closing under cost and freight terms in Japan at $765 per metric ton. This chart shows the intense upward pressure on this commodity. The valuation jumped $45 in a single trading session. That sharp increase immediately raises the cost floor for regional producers, compressing the available space for operational profit. A $765 naphtha floor shifts the break-even point for Asian liquid crackers reliant on imported feedstocks. This bullish upstream momentum forces the entire regional supply chain into a defensive posture. Producers must now attempt to pass those elevated costs downstream. Moving one step down the value chain to intermediate base olefins, specifically propylene, we can track exactly how those upstream costs cascade. For a production counterweight to Asia, we examine Manumace Gulf Coast. Here, U.S. propylene delivered Gulf Coast is ticking upward, currently sitting at 41.15 cents per pound. Contrast that firming place with softening Asian markets. China propylene dropped $35 to $1,055 per metric ton, and Korea dropped $15 to $1,025. This gauge visualizes divergent units, U.S. cents per pound against Asian dollars per metric ton. Standardizing them reveals a structural divergence. U.S. costs are firming, while price drops in China and Korea indicate softening demand, despite rising naphtha costs. To complete the global triad, we shift the analysis to the European market, focusing on ethylene. European ethylene, arriving cost, insurance, and freight into Northwest Europe, pushed up €35 to settle at €860 per metric ton. The localized trading convention of euros per ton inherently bakes currency fluctuations directly into the import-export parity math, adding a significant layer of risk. Base olefins are currently experiencing severe interregional fracturing. Local supply and demand dynamics are temporarily overriding global price parity. Moving further downstream into aromatics, we can isolate the most extreme data point in the August 10th report: styrene. The European styrene valuation, loaded free on board in Rotterdam, is sitting at $1,555 per metric ton. This bar chart compares that European peak directly against the Asian valuation. Styrene arriving cost and freight in China is only $1,075 per ton, even after a nominal $10 bump. That calculation reveals a $480 delta between the two regions. Exploiting a spread this wide requires executing complex physical logistics. Traders must book deep-sea freight and manage the long lead times required to move material from China to Rotterdam. Rounding out the report, final polyester precursors remain active. PTA sits at $885, up 15, and MEG is at $665, up 30, both under CFR China terms. Extreme downstream spreads like the styrene anomaly act as gravitational forces, dictating physical cargo redirections and global fleet deployments. Synthesizing the complete August 10 snapshot reveals Asian producers caught in a margin squeeze, trapped between rising naphtha costs and softening olefin demand. Contrast that regional pain, highlighted in yellow, with the premiums currently sustained in the European derivatives market, visible here in bright green. These daily feedstock intelligence reports serve as real-time barometers of industrial health and future pricing structures. To maintain a technological edge in tracking these shifts, Polymer Bazaar provides an AI-powered chatbot feature for immediate market queries. You can access these daily intelligence updates directly by messaging the word feedstock on WhatsApp to +91 93746 24365 or by visiting polymerbazaar.com. In a fragmented global market, a competitive advantage depends on the speed and clarity of the data you possess.